Did you know that to make 1 crore from Bajaj Finance shares on 20th of August 2021, you would have had to invest just 10 lakh rupees on 8th of Feb 2016. An impressive 10x return, right? No, wait for it, there's more. To make the same 1 crore from Bajaj Finance shares, you would have had to invest just 1 lakh rupees on 2nd of November 2011. Now that's a 100x return. It can't get impressive than this, right? No, it does get. To make the same 1 crore, you would have had to invest just 10,000 rupees on 1st of December 2008. A freaking 1000x return. Now you might think that this is probably a one-off case, but guess what? It's not. There are so many stocks that have given 100x return in the last 2 decades. To name a few, there is Divi's Labs, Berger Paints, Pidilite, Britannia, Shree Cement, Havells, Tata Elxsi, Avanti Feeds, Astral Limited, Balaji Amines, Naveen Fluorine, etc. These stocks that give exemplary returns are called multibaggers. The term multibagger was first introduced by Peter Lynch in his book One Up on Wall Street. It is used to refer to equity shares of a company that have the potential to generate returns that are multiple times higher than the cost of acquisition. So, if a stock's price turns from 10 rupees to 20 rupees, it is called a two-bagger stock. And when it turns from 10 rupees to 100 rupees, it is called a 10-bagger stock. But now let's talk about the elephant in the room. Is it possible to find stocks that have the potential to become future multibaggers? The answer is yes. There are financial experts who are renowned for their ability to pick future small cap and mid cap multibaggers. One such example is the ace investor Ashish Kacholia. He has been able to amass a wealth of around 1800 crores from the stock market. For the purpose of this video, I will throw light on 6 characteristics that you should look for in a company in order to find out whether it can be the next multibagger or not. So let's get straight into the video. The first thing that you should look for in a potential multibagger is healthy earnings growth. Companies which have a good revenue growth model are usually the ones whose income keeps on increasing. But there is a catch here. With increasing earnings, the company should also be able to maintain stable and high margins. Let's take an example to make it easy for you to understand. Observe carefully that both the companies A and B have increasing earnings consecutively for 4 years. But only company B is able to maintain high margins that are stable year on year as well. The second thing to look at is the P ratio of the company. Now for those who don't understand what is P ratio, PE or price to earnings ratio is simply the amount of money that people are willing to pay for the share of the company in exchange for 1 rupee of earnings. So let's say that the PE of Hindustan Unilever is 53 in 2022. It means that you will have to pay 53 rupees for the share of the company in exchange for 1 rupee of earnings. The formula to calculate PE is share price divided by the earnings per share. Now pay very close attention because we are going to discuss something very important. If we look at the PE formula in a slightly different way, then share price is equivalent to the PE multiplied by the earnings per share of the company. Observe very carefully what will happen to the share price of a company if the PE itself increases. The share price will also increase in multiples. To illustrate this, let's take an example. Let's say there is a company A whose earnings per share was 38.54 in 2018 and the PE ratio was 25.57. So using the PE formula, the share price of the company will be 38.54 multiplied by 25.57, which comes out to 985 rupees. Now, let's say the company's earnings per share grows to 88.26 in 2022. So ideally, the share price should have been 88.26 multiplied by 25.57, which comes out to 2256 rupees. But this company's PE wasn't the same in 2022. People were actually willing to pay 100.16 rupees for 1 rupee of earnings from the company. So the actual share price in 2022 was 88.26 multiplied by 100.16, which comes out to 8,840 rupees, roughly 4 times the previous figure. Let me tell you that all the figures that I've used in this example are of a real company, Tata Elxsi. The point of this example was to emphasize that you need to study the PE of a company in order to identify whether it can be the next multibagger or not. The third thing to look for in a potential multibagger is the size of the company and the industry it is operating in. Let's first talk about the industry with the analogy of the environment of a shark. It is said that a shark in a fish tank will grow only 8 inches, but in the ocean it will grow 8 feet or more. The reason for this is that the shark can never outgrow its environment. Similarly, even the fastest growing company cannot outgrow the market size of the industry. And so, when you're scouting for multibaggers, it is crucial for you to ensure that there is enough room to grow or that the industry in itself is growing at a rapid pace. It is also important for you to understand the size of the company as well. If you're going to bet on a company such as Hindustan Unilever to become the next multibagger, then you're probably living under a rock. The reason I say this is because today HUL has become so huge that to even double its income, it will have to incur a mammoth effort. On the other hand, a stock like Fine Organics Industries Limited, which makes additives for specialty applications in food, plastic, cosmetics, textiles, paints, rubber, etc., has the potential to more than double its income in less than 1 year. The income of Fine Organics Industries actually increased from 121 crores to 260 crores in the year 2022. Therefore, you should aim to find small growing companies in an industry that has huge market size. The fourth thing to look for in a potential multibagger is existence of economic moats. The legendary investor Warren Buffett says that companies with economic moats, or in simple language, competitive advantages, are the ones that can keep growing their profits in the long term. Economic moats that a company can possess are intangible assets such as patents, a lower cost of production due to supply chain advantages, a distribution network that is spread across the nation, or even a strong research and development team that strives for continuous innovation. In this competitive era, companies which can widen the circumference of their competitive advantage have the true potential to become a multibagger. The fifth characteristic that you should look for is a healthy capital structure. Capital structure is basically the mix of owner's equity in the company and the borrowed money, which we refer as debt. Usually, good growth companies with less debt on their balance sheet have the potential to become a multibagger. The reason for this is that these companies are consistently able to generate increasing free cash flows and then put these internally generated accruals towards the further growth of the company. For those who don't understand the term free cash flows, it is the amount of cash that the business has generated which is free of any internal or external obligations. So you should keep an eye open for companies that are consistently generating increasing free cash flows and diverting these internal funds towards activities such as increasing the production capacity, targeting a new geographical area, or even launching a new product line. At last, you must also look for a driven management team. A robust management team that has the required skills and understanding of the business knows better of where to put the money and derive growth from it. They also ensure that an appropriate governance structure is in place so that the company can function in a smooth manner. One should also look if the promoters are headstrong and determined towards the vision of the company. A high promoter holding is a good sign of their belief in the vision of the company. In case of some companies, the promoters are so engulfed in the vision that in times of crisis, they even increase their holding in the company. So all in all, multibaggers are great investment options to build huge wealth in the long term. But there are also certain risks that are associated with it. For example, the share price journey of a multibagger will not at all be smooth, and one might have to incur substantial losses if they suddenly need the money in between. So ideally, if you are new to the stock market with limited funds, then investing in multibaggers might not be the wisest decision, but they do have the potential to make a life-changing impact.